We're going to be looking at 2 Wiley Plus problems for this week, week 8 of our semester. We're going to look at exercise 6-2 and problem 6-4A. By far the more difficult one, I believe, is problem 6-4A. And so I'm going to go through this one first. If you're looking for exercise 6-2, you may want to fast forward to maybe the last 4 or 5 minutes of this video to see the examples for that one. So quickly, let's get a summary here of what's going on. All in all, they want us to determine and produce an income statement showing how will this company's financials be affected using, if we use the FIFO method or the LIFO method. And we've got a lot of blanks to fill in here. There is a page towards the end of this chapter, chapter 6, that does have an income statement that looks just like this, although filled in, but hopefully this will help you as well. Well, when doing any income statement, what I like to do when I'm doing this problem is let's just start filling in with things that we know. So they give us net sales here. They give us, our beginning inventory, $25,000 worth, with 12,600 units. Notice here they only give us the ending inventory in units. They don't give us a cost. And that's because we don't know what the cost is. It depends on what method I'm using. And then we show we have some purchases. Notice here they do equal the same. We had 992,700 in purchases. That does show here of how much I did purchase. Here they're just showing how the breakdown was of those purchases. And then finally they tell us how much normal expenses we had, operating expenses like depreciation, like utilities expense, like advertising expense. And then they tell us the tax rate is 40%. If you remember back to my first video, using FIFO or LIFO could make a difference in your taxes because one of them will most likely give you a higher or a lower net income. So let's start looking through here, and I'm only going to do this for the FIFO side. But let's start filling in this income statement. Now, I believe we're doing this for the year, but let's just make sure. We're giving the results for 2017. Yep, I don't see anything that says anything about a month. So remember, for income statements, we always use as of or for the whatever ended. So in this case, year ended. And then the top of an income statement always has sales. So we're going to come down here to our total sales revenue. In this problem, they don't talk anything about returns, sales returns or sales discounts. They went ahead and just combined everything into total net sales instead of having us do that later. So we have total net sales of $1,344,600. $1,344,600. Now you need to think, how is total sales going to be different if I use the LIFO? Nothing different. I haven't done any calculations yet. I like to put commas in. You don't have to. So your total sales for both FIFO and LIFO are going to be the same. Now, they didn't come out and just give us cost of goods sold. So that's the next part that we have to actually calculate here in the income statement, is our cost of goods sold. And how we get that, remember back to my previous lecture where I talked about doing it the periodic method. We always need to take our beginning inventory. So here our beginning inventory told us we had 25,200. And I need to add in all of my purchases for this time period. And I just need to find where it shows my purchases. There it is, cost of goods purchased. And my cost of goods purchases here was $992,700. And then if you go back to my previous lecture, when you have this listed out, beginning inventory plus any purchases, gross purchases mainly, because I mean this is my net purchases because it would have included any returns that I had or any extra shipping costs. Remember, that's going to tell us how many goods I actually had available for sale at the highest absolute point possible. when I add up these two. So let's go ahead and do that. I'm going to bring up the calculator. I know you won't be able to see this. But off to the side, I've got my calculator of 25,200. I need to add in the 992,700. And that's going to tell me I have 1,000,000 and then 17,900. If I was looking at this from the LIFO side, again, nothing has changed. I still have beginning inventory the same. I still have cost of goods purchased the same. My cost of goods available for sale are still the same. It's only when we get to here are things going to start being different. Because remember, when you have cost of goods available for sale, you then need to subtract out your ending inventory. And the ending inventory is going to be different depending on which method I use. And we're going to be doing it the FIFO method. So that means all of my beginning stuff is gone. So I'm only left with 30,000 units of my most recent purchases. So therefore, these guys are gone. They were the first ones out using FIFO. These guys are gone. These are gone. These are gone. I'm left with only 30,600 at $3.15 a piece. So I pick up my calculator, 30,600 items in ending inventory, and they cost me $3.15, the most recent cost. That leaves me an ending inventory amount of $96,390. This number will be different for your LIFO side. Now, for the LIFO side, when you're doing this from the LIFO side, you're last in, first out, so that means these guys are gone, these guys are gone, these guys are gone, and you might think, oh, I have 30,000 left here, 30,600 at this cost. No, you don't, because remember, you also have beginning inventory up here that you need to remember about. So really, if you have 30,600 left, 12,600 of those are up here. The remaining 18,000 are here. So you have two items that are still in ending inventory using the LIFO side. Okay, let's go back to our FIFO. Cost of goods minus our ending inventory is our cost of goods sold. So let's do the math. We got 90. I got 100. Let's just do it here. 1,017,900 minus the 96,390, and I'm left with 921,510. Now that I know my cost of goods sold, now I can do my real equipment, get back to the real income statement. Sales minus cost of goods sold gives me my gross profit. So remember, okay, here's my sales. Sales was 1,344,600. Subtract that, the 921,510 that I just calculated, and I'm left with 423,090. Now, just like any other income statement, I'm now ready for the expenses. After I've done my cost of goods sold, I got gross profit. Total expenses, it told me that in the opening problem right here. My expenses were $130,000. Actually, I'm going to want to call that, operating expenses, because that's actually what it is. Now, when I take gross profit less operating expenses, you may think that's regular net income. Yes, almost, but in this case, if we're a corporation, we also have taxes that we need to do. So we're going to call this, actually, this is going to be called, let me find it, here, income before tax. So we've got 423,090 minus 130,000 in operating expenses. So that brings us down to 293,090. Now we have income tax expense, and it told us up here that my income tax expense was 40%. So I want to take 40% of that 293,090, and that leaves me, that gives me 117,236 going to the government, which is a big chunk. Now I can finally get my actual net income by taking the 293,090 and subtracting out the 117,236, and I'm left with a net income of 175,854. So that's how you're going to do, and then again your LIFO side will be very similar. The main numbers are going to change as your ending inventory is going to be different. Therefore, your cost of goods sold will be different. Most of the rest of these numbers will be different from there on out with using LIFO. Now, the second example that I wanted to look at was 6-2, and I'm going to go through a couple of these. So what they're looking at here is we're looking at the plant company, and we're trying to determine if, or actually the plant company is looking at this Shuta company's inventory. Did the Shuta company actually do their inventory correctly? So they're telling us, and maybe off to the side you may actually want to do an inventory T account. I like to do that. So that's what I'll be doing over here to the side where you can't see. But I'm going to start out my ending inventory account with what they show, and then decide, do I need to add or subtract anything to this beginning 819,000. That's what they show as their ending inventory. Now it's our job to go through and did they do everything correct. So I look at this first one, and included in the company's count were goods with a cost. So this was included now, and we got to decide, should it have been, or do we need to take it back out? 284,000 that the company is holding on consignment. These goods actually belong to this company called Harmon Corporation. Now, when I think of consignment, I like to think of a gas station selling newspapers. The gas station sells, say, the USA Today. The gas station does not own those USA Today papers. They're simply selling them as a convenience to USA Today for them. And then the gas station would take a % of the profit of the sale price and then give the rest of the money back to USA Today. So for example, let's say USA Today sells for $1. What they're going to do, USA Today, for every paper that's sold, they're going to request 80 cents be sent back to them. The gas company gets to keep 20 cents of pure profit. All they had to do was just hold the items in their store. And then for any items that aren't sold, what the gas company does is tear off a piece of the paper or like a barcode and then send that back to the company somehow, however they do it. And then that company will say, okay, you don't owe us for that. All you owe us is for the 10 papers that looks like you did sell. So 10 times 80 cents, you owe us that $8. You keep the rest of whatever is remaining from the sale price. So when goods are on consignment, those aren't your goods. So we have to act like those should have not been counted. So I'm going to put this in as a negative because we need to subtract out those goods from our ending inventory. They should have never been in there. Okay, now let's look down to number 2. The physical count did not include, so we have to decide, should it have been, items that were purchased by us for $35,000 and shipped FOB destination. That means, remember, it's free on board. It's free to me, the buyer, until it gets to my house. This also tells me when transfer of title happens. Transfer of title happens at the location listed. So therefore, the transfer of title doesn't happen until it gets to my store. So even though I bought it on the 28th and it was shipped on the 28th, those goods didn't arrive at my store until the 3rd of January the following year. So therefore, the transfer of title did not happen until the 3rd of January when it got there. Thus, we did it, or the actually Shuta company did this correctly. They should not have included it, and they didn't. So if there's no effect, we enter 0. Now for the last one I want to go through, let's skip down here to number 5. I think this one is probably the toughest one out of all of them. And what I would recommend for you to do is off to the side on a separate sheet of paper, have a inventory T account, just a little one off to the side, just for this problem, not your main one that you're working with from the start. And then you might want to even do these journal entries off to the side. So basically what happened here is Shoot a Company sold items to our customer for $81,500. That was our sale price. And they cost us $54,000. Now, what really happened is that says here that our customer only really ordered $16,500 in goods, not $81,000. And that would have, if we would have shipped the right amount, it would have only cost us $8,100 in goods in inventory leaving. But we wanted to up our sales, show that we're doing pretty well this quarter or this month or whatever it is. And so we said, yeah, we know they'll probably return it, but let's make it look real good for right now and sell it for $81. And then they'll probably ship it back to us. They'll be mad, but they'll ship it back to us. So what we have to do on this one is we have to act like we never really sold this. We really only sold $8,100. Even though $54,000 left our store, we can't be fraudulent and actually count that. We have to only record the sale as of what the customer really ordered. So on my inventory off to the side on my little sheet, I would have had a credit to the inventory for $54,000. Now we're not worried about sale prices on this exact problem. We would have to go back and redo the sales too. But for this problem, they're only looking at inventory. So on my little inventory T account, I would have a $54,000 on the credit side showing that I lost inventory. And then I'll skip a little bit and then draw a total line. Below the total line, I'm going to show what the answer should have been. The answer should have been $8,100 on the credit side. So now I have $54,000 on the credit side up top, a final total of what it should have been of $8,100. What do I need to do to my inventory T account to go from a negative $54,000 to only a negative $8,100? And hopefully you answer, you need to add it back. And that's true. We need to add it back as a debit. But in this case, we're going to show it as a plus because that's how we're doing plus or minus on this one. So we take the difference between the $54,000 and the $8,100, and we need to show a positive inventory increase of $45,900 for this problem. Okay, the rest of them hopefully you can do on your own. That will conclude our 2 Wiley Plus examples. If you like these, let me know in the comments. It really helps. Or put a like sign to it. I like to know how many people are actually watching and getting a benefit out of it.